All right, good morning. Good morning, everybody. Thanks for jumping in. Good morning. Good morning. We're going to get started in just a moment. All right. So I got to share my audio here. So I was forgetting that. Here we go.
Of the Atlanta Black Chambers, the Chamber of the Year.
Atlanta is rocking. Go Global Conference is doing the things, eh?
And I think the most incredible thing to take actually home is the Black excellence.
So kudos to GOC for a job well done. I think this is just the beginning of greater and better things to come.
There is a black business.
All right. All right. Good morning, everybody. Thank you for joining. Welcome to the Power Hour, where the hour shall pass and the power continues. The power is within you. The name is Ricardo Berries. I have a special guest here that we're going to be talking to in a minute, but just a few housekeeping. If this is the first time that you're joining the Power Hour, welcome. Please use the chat for or loyal attendees. Please use the chat as well. Let the folks know who you are, where you're coming in from, where you're joining in from. You can use the chat to exchange your contacts. Let folks know what it is that you do and what you're actually looking for. The Global Opportunities Committee of the Atlanta Black Chambers focuses on opportunities around the world for our members, regardless of where you are. You don't need to be in Atlanta to be a part of the chamber. You can be from anywhere in the world. And thanks to our international membership, thanks to the Global Opportunities Committee and our hardworking teams who ensure that you can be a part of the Atlanta Black Chamber community and the Global Opportunities community, the global community. We say go global because you're already global and you don't even know it. So feel free to find out how you can be a part of the inner circle that we have. We do a lot more than just the Power Hour, and we want to make sure that you can participate in it. Let's keep those microphones on mute. We will be taking some questions at the towards the tail end of the Power Hour. If you muscle up any question during our conversation, feel free to put them in the chat, or we'll give you a chance to come on stage and talk a little bit to our guest here if you have any specific questions. And then the last thing I'll say is we're going to be dropping a poll as well midstream into the show. We'd love for you to have that participation. For regular attendees, we want to ensure that we have about 85% participation. So get ready for that. If you know someone who should be here and they are not, tap them on their shoulder, ping them, let them know that, hey, we're about to have a powerful conversation, very insightful, and you actually don't want to miss this. So we're gonna go right in. And I have Darius Grant here. Darius with me. Darius is one of my, I guess we now are brothers. My dear friend, brother. We've connected on several occasions, and we always seem to be in the same room, which is powerful. And Darius is got some real gems and knowledge that he wants to share with us, and I want to give him an opportunity to we get started here. Darius, welcome. Thanks for jumping in on the Power Hour. I know you, but folks don't, so we'd love for you to talk a little bit about who you are and tell us a little bit about what you do.
Absolutely. And first, want to start off with just thanking you for extending the invite. I'm happy to be here today. And so, quick introduction to me. I'm actually a I guess I would say there are a lot of layers to this, right? So I started my career in accounting, and eventually developed my expertise in finance. So worked at KPMG as an auditor. Decided I wanted to go down more of the finance track, so went to go work in investment banking and mergers and acquisitions, as well as fundraising on the lending side. And then decided I wanted to get more into the investing side, so the private equity world. So I had applied to Columbia Business School in New York, was fortunate enough to get in there, to be accepted there, spent a couple of years there focused on private equity as well as technology. And post my experience at Columbia Business School, ended up moving out to Los Angeles to work at a private equity fund, which now I believe manages somewhere around $8 billion, but specifically focuses on B2B software investing. So that was where I really got to kind of hone my experience on, working alongside founders, executives as they thought about raising capital. So the interesting thing, and I know most folks are more interested in the fundraising side here, so I'll just double tap on that. But the interesting thing about my experience within investing is, one, we had a multi-strategy approach. So I got to look at both minority investments where we were looking at putting capital in, and we would only take a minority of the equity as part of that investment. Uh, Also, we did buyouts, so where we would go in and acquire a majority of the equity, and sometimes even assist those companies. Well, many times assisting those companies with going out and making additional acquisitions. So, great part about that is, my I was immersed in software. I got to see everything software, which really sparked my curiosity for emerging technology. At that firm is where I started to develop a thesis around artificial intelligence. So this was probably around 2017. So before all the LLMs and chat GPTs and the cool note takers you all have on the chat were actually available. And that kind of clued me into the transformation that would happen. I saw it coming from the perspective of artificial intelligence. And so beyond that, still kept my investor cap on, but also wanted to hop in and kind of make some waves as an entrepreneur. So started and invested in a company called Tesoro AI. So Tesoro AI is a talent acquisition firm focused on headhunting services and also staff augmentation, but for talent out of Latin America. The idea came because as I was working in private equity, we saw opportunity to assist our portfolio companies in scaling. And usually the number one challenge they had was finding the right talent. And at the time, I did notice that a lot of investors were kind of leveraging Eastern Europe and Latin America, Eastern Europe, I should say, and the Middle East as a location for outsourced talent or offshore talent. But the world had not yet moved into how do you leverage nearshore talent? And I'm thinking about countries in the Western Hemisphere. I know we've got a global audience here, but how do you leverage nearshore talent, time zones, and AI, blend that together to create industry-leading products teams that can produce on a scale and efficiently enough to help both raise funding and achieve some of these milestones as it relates to growth. Still in and around that business, and then we've got some other projects. I've got some other projects in AI infrastructure, so think data centers. So a lot there. There's a lot there to unpack. I didn't mention everything. I don't want to take up the entire time with the introduction.
Yeah, no, thank you. That's a lot that we are going to be unpacking over the next couple of minutes here. This is about the new rules of raising capital, especially if you're looking to do business internationally. And one of the things that I coined a phrase that says, you're local with a global reach, so that makes you local. I mean, glocal with the GLOCAL. And so a lot of people just sort of think that they don't need to do anything outside of their, backyard because, they're not focused on that. And it's like, well, you're already doing that because you live in an international world, in an international community, especially if you're out here in Atlanta. But this conversation I'm particularly curious and excited about because it's new rules for raising capital, especially if you're doing and looking to do some global business. As we think about how landscapes is shifting around raising capital, right? But maybe we can start with some foundational stuff, and let's start about that capital raising. Like, what's that process looking like? If you were to explain that to, a novice, someone who doesn't know, what exactly is that? Like the process of raising capital. Can you explain it to us from your perspective?
Yeah, so essentially you've got, and it just depends. It depends on where you are, right? So you've got folks who want to raise capital, they just have an idea. And certainly that happens, right? There was someone who just came out of OpenAI, which is the company that is responsible for ChatGPT. She left OpenAI and raised $2 billion, right? Only had an idea. So there's that. There's also raising capital for established product or established companies, right? So you're talking about somewhere, and let's just say this is in the venture capital world, somewhere around a seed or Series A, Series B, Series C. As you get further along in those series, you're a more mature company. And then you move into what we're calling, private equity, where you've got firms who are looking in to acquire more mature businesses, a majority stake of that business. Beyond that, we could talk about, IPOs and whatnot. But essentially, raising capital is going out looking for an investor. The principal job is to fund companies and receive some type of return on their investment. What I spoke about up to this point is equity investors, right? So folks who are coming in, they want a portion of the equity in the business. The other side of that is also lenders, right? So you've got your traditional lenders who are coming in and, they can provide you with traditional types of debt from bank debt, right? That's going to be the most secure type of debt, most senior type of debt. Those are for more mature businesses, all the way to down to debt that looks like equity, right? And so there's a lot of nuance within that. But yes, you do also have investors who are providing investments that are structured like debt. You've even got this kind of new breed of investors in venture capital who are investing, but it's called revenue-based financing. And so these are for startups where the investors saying, hey, look, we're going to structure our investment like debt, but our payback schedule is going to follow your growth in revenue, right? So hence the word revenue-based financing. So the world, in terms of what the investor actually looked like, is expensive.
Yeah, a lot has changed because typically when you think about the investment, it's the investor giving you the money and sort of scheduling a return on that investment. But the things that you just shared around, you can get debt, you can get this rev base. And you said something that was interesting I want to touch back on. You referred to the case of OpenAI. You leave an existing project or an existing operation, and you have an idea. You don't want them to sort of use that idea or have it. So you basically create your own business. and you raise funds from there. Let's talk about the stages though, the stages of business, because you can have an idea and people would want to throw money at that idea because they believe in not so much in the idea but also in you. And so let's talk a little bit about those stages, and what stage is the recommended stage to actually raise capital? Is it okay to raise at any stage?
It's okay to raise at any stage. The reason for the raise is what's most important. So first it's defining like who are we actually talking to? Okay. So if I've got this idea or I even have a software company, I could be in good position to raise for venture capital, but the way venture capital is going to look at whether they will finance that business, whether they will invest, will be, is this a business that we believe can reach a valuation of $1 billion? Why? Because of how their funds are structured, right? So if their funds are generally structured to where they have a lot of losses and they have a few big wins. So those big wins have to offset all of the losses, right? So if they write 100 checks all for 10 million, maybe 10, and they're not going to write 100 checks out of one fund. I'm just using numbers. But they're going to expect 10 of those to hit it big, and then the other 90 will probably be not very exciting, right? So if you're approaching a venture capitalist with a real estate or with a services type of business, they're not going to be excited, not because it's not a good company, but because that's not how they invest. Now, there are other groups who are saying, well, our portfolio construction is a little bit different, right? We're going to make fewer investments, but those should have a higher probability of success. That's where you can start to see services businesses coming into play. Now, they won't be venture capital firms. They could be like family offices, high net worth individuals. This is also where, lenders come into play as well. But just understanding what type of investments that the individual firm makes is important. Now, getting into stage, if we're talking again about venture capital, just quickly defining the stage, you've got like a family and friends round, which means you're literally raising capital from people who are close to you. You're probably still at an idea phase at that point. And that's not going to be a bunch of money. And then we can go to pre-seed. Pre-seed is the next phase where you're beyond the family and friends round. You've got an idea, maybe you've got a prototype of your product. Then you go to a seed stage. Seed stage is a little bit more mature, right? You're going to raise a little bit more money. Seed stage, you don't necessarily have to be generating revenue, but you've got some sort of semblance of some traction there. Now, once you get to Series A is where the investors want to see and analyze the business a little bit more. So a couple of the standards that Series A investors are looking at, Series A investors are saying, hey, is there revenue that we can look at? What is the show me your revenue profile, right? I now want to analyze that business. It's not always the case that you reach Series A and you have revenue, but there has to be some significant traction from either a user perspective or something that indicates that this will be some sort of successful business. There is what's called product market fit. Now, beyond Series A, you've got Series B, C, D, E. I would kind of say once you get to Series B, C, D, now you need to have some revenue, unless you're one of these, like, I don't even want to call them rock stars, but lucky entrepreneurs who have an idea where venture is just coming in and saying, we want to back you no matter what. For everyone else out there, which is 99% of the people, you're going to need to have revenue. You're going to need to have growth. And you'll need to have your financials in order, because the investors are going to want to do their due diligence, right? And so you'll have to understand what metrics are important to those investors. And that's where you start to get into a profile that's slightly different from VC. It's called growth equity. Okay. Growth equity, they're investing in growing, usually tech companies, writing bigger checks, but also expect to see some more traction, right? There's more for them to look at to see, how the business is built and what its future should look like. And then once you get further down the road, that's when you start to run into private equity. Now, private equity starts to look at acquisitions, usually when they start to have about 10 million in revenue. You will hear of acquisitions that happen of businesses that are smaller than that. But generally, it's because the private equity firm would like to buy that company, that smaller business, as part of a larger portfolio company, right? So that's called basically a roll up that they may be looking for, which is important. Now you've got some micro acquirers as well. An individual who just wants, they may want to acquire 1 million, a business that's doing 1 million in revenue, maybe 10% margins, and they think, hey, I can scale this up. So kind of generally speaking, those are the different phases.
Yeah. Now that's powerful. So just so that we are clear on the stages, so family and friend round, these are people who know you, who you know, who don't mind parting ways with a couple $1,000 and say, hey Darius, we love you. I think you're a good guy. We know you from high school or from church. We got 10,000 in the bank. We trust you. Here you go, and we give that. And then you move on to the seed, the series. Then if you get blessed, you go to the private equity, and then you can kind of take off from there. A lot of the folks who probably are listening to this conversation are probably saying like, "Man, Darius, this is above my pay grade. I don't even know when I'll hit $1 million in revenue." What should we be thinking about as operators, as people with ideas? What should we be thinking about to attract the necessary capital as we think about the rules? Because we have a lot of people here that are in professional service business, and we
Mm-hmm.
see that this professional service business is intersecting with tech a lot. And we're going to talk about AI and investment with AI in a short while. But what would you say to the folks who are thinking like that and is thinking like, I don't know if we'll ever get there because my business is not tech. I'm not sure if I'll ever make that mark to get that sort of capital.
Yeah, I think if you are on the services side, I mean, most venture capital firms, it's just not their strategy to invest in services businesses because they don't scale the way that they would need to scale in order to meet the demands of the venture capital firms' investors, right? So venture capital firms also have investors and need to go out and raise capital, right? So coming all the way back to services businesses, you have to look at a different type of investor. Throw the venture capital firms out of the picture for now. Focus on firms that would actually invest in a services business. That's where you start to see, and this is the reason why revenue-based financing or revenue-based investing got started, right? Because the investor in those types of investment vehicles can still earn a return. The benefit is that services businesses are a bit more predictable. Okay. So services businesses, very straightforward. Let's just say you own a lawn mowing company. Very predictable business, and you can get that started with very little upfront capital, right? Generally, you can get that started with either sweat equity, right? Or you're working a job and you're able to use your job as effectively your first investor. As you scale it up a little bit, let's say you start to do somewhere around 50,000 in let's just say monthly revenue, or let's just say quarterly revenue. Right now, you can start to have conversations with someone who does do revenue-based investing. Now, what they're going to say is still, I want to look at your numbers, right? Because a services-based business is able to. So the difference between service-based and software is like there are all these upfront costs that are required to build a software company before you can even sell it, right? Service is different because you just go out there and do it. And so you can generate revenue upfront, which then lends it to this revenue-based financing model a little bit earlier than what software companies are able to do. So the model for how the actual structure of the investment is going to be different for revenue-based investing in revenue-based financing. It's going to be a portion of that is going to be paid back to the investor based on sales that are generated. They're also, because they're taking more risk, right, relative to a pure debt investor, and it's early on in your company's life cycle, they're going to want, some equity upside as well. And so, I would just say that's a lane to start considering as you think about fundraising. The other lanes, right, outside of the equity investor role is looking at small business loans as well as a lot of the grant funding. I think grant funding is an area where a lot of people don't tap into, but there can be a lot of benefit to actually, just exploring and seeing which would be relevant and worth applying to.
Yeah, yeah, no, that's awesome. The chat is blowing up. I think this is very intriguing, and you're drawing a lot of feedback here. I've got some questions I want to touch on before we get too far in. I know Kimberly's asking about the credibility. What type of credibility are VC normally looking for from a startup project?
Yeah, credibility. So VC, again, now we're talking about like the high growth tech space. They want to know in the very early phases, if you're talking about pre-seed, family and friends is basically saying, hey, look, I trust you. Here's X amount of dollars, right? But like the investors themselves are basically betting on the team in the very early phases. So the key question the investor is going to ask is, do I believe this person has the talent and capability to pull off this idea, right? Whether I think the idea is good or not, do I believe that this person and the team that they've put together have the talent to pull this off? That's question number one. You can back that with historical examples of things that you've done that would prove that you could pull this off, or some sort of expertise in the space. Okay. The other part of that in terms of credibility would be the team that you bring in. There is a lot of focus on, all right, well, who is the talent? Unfortunately, it's the case that a lot of investors want to see like big names come into play, right? That doesn't always have to be the case, but it does happen a lot of times. And then on the other side, with credibility, is the question that investors are asking is, effectively, when the crap hits the fan, right, the market changes. Why will you stick with this, right? Because inevitably, as a founder of a startup, that business is going to go through a significant change. And why do I believe that you will not just walk away, right, when it gets challenging? So there has to be some underlying reason other than wanting to get rich. There has to be some underlying reason why you will stick with this business when it looks like it may fail, right? And I've seen plenty of stories where literally startups are like on their last 2 weeks of cash and the founders are still riding it through, right? And somehow they got an investment, turned things around. In fact, I was speaking with a founder recently, very exact same scenario, and now they're doing like 20 million in recurring revenue, right? But ultimately, they had to have a real reason why they were going to stick with that, because there's always, everyone here is talented, right? And you can go back and get a BW too, right? So why not just say, you know what, forget this, being a founder is too hard. I'm going to go back and be W2. As an investor, I want to know, all right, I can't just have you quit on me.
Yeah, yeah, no, that's very interesting. The staying power. Janelle is asking about project-based financing model. Can you speak a little bit about that? Because we talk about the rev base that works very well if you're a service-based business, but what if you are sort of you work on specific projects? And I know, for example, Janelle is in the solar business, so she may end up getting some solar contracts. And can you speak a little bit about the models for that?
Yeah, for solar, I'm not as experienced in solar. I know that's project-based finance. I wouldn't be able to point you in the best direction for that. So I don't want to get beyond my skis and send you down the wrong path there.
Yeah. Yeah, but I think, obviously it's some of the fundamentals that you talk about, being able to prove that you are able to deliver on this project, right? So, your
Hmm.
team, your capabilities, and obviously, the payer, because if it's a project, then it's can you then sort of show your schedule of how you're going to be getting paid back. So there's some credibility issues there that has to be sorted out, especially when you're working internationally as well, right? I see Kimberly is asking about
Yeah,
the
I can
average
actually I can expand on what you just said because
yeah,
we are looking at that like there's a data center, building a data center, right? Essentially a project now is a long-term project. But what you see is that the more certainty you have that there's an end customer to the project that you're building, in certain spaces, you can raise capital based on customer commitments, whether it's like a letter of intent. Um, Ultimately, what that does, and this is what any investor, despite asset class, round, size of investment, all of them are trying to think about how is this investment de-risked based on this conversation that like what do I understand about this best investment that has what has the founder done? What has the executive done to de-risk this investment, right? For me. And having a project with some sort of indication of interest from customers is going to de-risk that. Right.
yeah, yeah, that makes sense. Kimberly was asking what's the average percentage of equity most of the VCs take from tech companies?
Yeah. Generally it's 20% per round. Okay. That doesn't always have to be the case. Some people will come in with term sheets that are more aggressive or less aggressive. Also, the market dictates a lot of what happens. So generally it's 20%. But I think the thing that for most people, most founders, what are the terms? Like what kind of instrument are they using? Right. And we don't have to go too much in depth, but the instrument they use determines what percentage they get on the exit, right? So a great example is a participating preferred investment, right? I could invest $10 million into the business. And if it's a participating preferred investment, that means you have to pay me back whatever my liquidation preference is. So if my liquidation preference is 2x, right? That means you have to pay me 2x my investment, so $20 million minimum before anybody else receives anything. Okay? So that's the preferred side of the participating preferred. Okay? Now, participating means that remaining 80 million that's left over, let's just say we sold for 100. So I came in for 10. My 2x like liquidation preference demands that you provide me with 20 million. Okay. And then the remaining 80 million, let's say and I will also participate in the distributions of that 80 million. Right. And so with that participation, let's just say I get another 20% of the 80 million. So I get another 16 million as the investor, right? It's important to understand terms like that because those terms dictate what the payout schedules will be. So I could come in and I can invest $2 million on a $10 million valuation, which effectively means post money valuation, which effectively means, look, I would then own 20%, but what I own on the exit is different based on how the investment is structured.
Yeah, yeah, powerful, powerful. Paul is asking, and we see a lot of the questions that we want to get to quickly. Paul is asking how do angel investor fits into this puzzle, and how do they
Yeah.
differ, say, from large VCs or other than just the amount of money they invest in?
Angel investors are coming in at a much early phase. They're generally investing their own capital or a group's capital, but they don't have a dedicated fund, right? It's not a dedicated fund in the way that you would see venture capital. So angel investors can come in generally on the friends and family, or the pre-seed round. Once you start to get more advanced, that's when you start to see actual professional investors with a dedicated fund and a thesis behind how they invest.
Yeah, yeah, awesome. So we're gonna start the poll and we're gonna run the poll for a few minutes because we're midway to the power hour and we're gonna continue the conversation. If you'd like to participate, we want to get to 80% participation rate. So please give us your thoughts on if you're raising money, if you've raised money before, how much money are you raising? It would be nice to kind of understand your take on some of these. So as we continue, Darius, you brought up some really, really interesting point, and I want to touch as much on them as possible. Let's talk about this whole thing around smart money and how do entrepreneurs and business on this call sort of attract smart money? Like, what is smart money, anyways, and how do we sort of attract that sort of capital?
Yeah, the way what I would consider smart money is people who understand my business. So I think the error that a lot of people who raise funding go out and they just kind of spray and pray, hoping that someone will just give them money. Unfortunately, you end up wasting your time with a lot of people who even if they're nice enough to answer the call or set a meeting, if they don't understand your industry, if they don't make investments in what you're trying to build, is very low probability that you're ever going to receive money. And if you do receive money, it's an even bigger problem that they don't understand what you do because you're going to have to meet and be you're going to have to be accountable to those investors. So they're not going to understand why you make certain decisions because they don't actually understand your market. So what I generally recommend is for anyone who's raising capital, find investors who are aligned in terms of the industries they invest in, whether they are investing in or the type of product or service that you have, right? And though you will have much more productive conversations, sourcing a investor will be a lot easier if you can have a conversation that is an educated conversation between the founder and the investor.
Yeah, that's super interesting, and it kind of reminds me of interviewing for a job, right? You want to find the ideal person. You got to ask them a lot of questions. So this is the investment criteria. That's the first thing that you want to talk to your potential investors about to make sure that there's alignment and you don't waste that sort of time. Bethany is asking about raising for M&A. What about raising for M&A, and can we use private money or family office or UHNW. I don't know what UHNW is. I don't know if you know, but we'd kind of like to break that down for the audience.
Ultra high net worth. So when let me clarify the question. Raising for M&A, does that mean that you want to find capital that would help you to acquire another business, or you would like to be acquired?
Yeah, I think she's speaking, and Bethany, you can clarify, but I think she's speaking around raising for acquiring other businesses.
Okay. Yeah, definitely possible. Couple routes to go. Look towards private equity for that. There are scenarios where, the kind of growth equity investors and venture capital do assist with that. But private equity can come in and help and provide capital to help make an acquisition, and then they would take equity in the combo co or the combined company, right? So there are also investors who can do that. And then it really just like what size of acquisition are you trying to make? If you're making $1 million acquisition, a ultra high net worth individual may be able to serve that same purpose. And then you can also start to look into seller financing, where you can reduce the upfront check size so that basically the capital outflow at the beginning isn't as high.
Yeah, yeah. That definitely makes sense. So let's talk about the role of AI because this is the conversation on everybody's lips now in terms of, AI and the talent conversation that you just had and that strategic partnership in securing investment. I know you also have a play in AI and you do a couple of those things. But these are some of the things that the language that some of the investors that are looking to hear in terms of your application of this sort of thing. Can we talk a little bit about that?
Yeah, yeah. So for sure, that's a huge question. It used to be a little bit frustrating to founders why investors were always asking about AI, but today, as you see, the capabilities, what AI can do for a business, it actually is paramount to have some sort of strategy around how to implement AI, whether it goes into your product, so your product is more valuable, or whether it helps you to run a more efficient business. Now, the reason for that is because let's just look at the efficiency side, right? That investor can invest. There's a pool of, let's say, companies that look similar to yours. If you're the only one that's not using AI to run a more efficient business, then theoretically the other businesses have higher margins. And so if I'm the investor, I would prefer to invest in the business that has higher margins, because what's going to happen is, as the seller, you'll say, well, of the other nine businesses that look like me, they're all selling for, or they're all getting investments based on, let's just call it 5x earnings, right? I would like that investment too. However, if I'm the investor and I'm saying, well, the other companies are using AI and they're running a little bit more efficient, right? Now I have a higher likelihood of getting a higher return, because those companies, while all are in the same space, those companies are operating more efficiently. And AI is absolutely is making workflows more efficient, right? And then if we move over to the product side, right, if your competitors are using AI in a way that makes their product more valuable, more sticky, more or I should say less price sensitivity on behalf of the customer, they're going to be able to sell more, which also increases their margins, right? So what's happening with AI is actually changing the X's and O's that you see in a business. And so as an investor, you're looking across a swath of investment opportunities and trying to decide which one is going to be the right one. The investor is going to prefer to put their money into the investment into the company that is able to leverage what AI is doing relative to those that aren't.
Yeah, that's interesting. So investors are looking for how you're using the AI and integrate that into, whether on the talent side or on the delivery side. What about the challenges and the drawbacks to this raising capital? Like how does the rule apply there? Because it's, everybody needs money, and a lot of times it's not money that they need. So I want to also talk about that, and any drawbacks that you've seen in your experience and the challenges in raising this sort of stuff.
In raising capital for,
Well, raising capital for any of your projects for your business.
yeah, yeah. I mean, it may be that you need expertise, right? So um, you can get the expertise, like let's say if you're raising capital because you want the expertise of a certain investor, have a perspective on what they should be able to provide, right? So is their expertise going to allow you to then improve or get to customers that you can't reach, right? There is a case where a lot of venture capital firms can open up the market to additional customers. Or is the expertise from a technical perspective, right? So is that investor going to provide some sort of technical element? The drawback could be whether you can just go find that expertise and provide a little bit of equity, right? Bring that person on, bring the actual expert on as as an advisor, right? And then a lot of people focus on raising capital because well, here's the major issue I find with a lot of startups is that there is absolutely a need to go raise capital. Why? Because the burn rate on the company is high enough to where their revenue isn't actually able to fund operations. My question is, was raising capital actually necessary? The numbers would say yes, but perhaps the operational model, if there were a different model, would say no. So this is where I think talent comes into play. So in my experience, meeting with hundreds of companies trying to scale right? And you all would probably agree that talent ends up being the number one expense for the business. And typically, when you're raising capital as a growing business, it's because you also want to go hire more people to help you to continue to scale. And so, how can you think about talent in a way that will actually postpone the necessity to raise capital or prevent it altogether? And that's where I believe that the nearshore model becomes important. So what that could look like for folks who are in Europe or in Africa, finding pockets of lower cost talent, equal quality talent, where you can accomplish the same objective that you would have if you were to hire, domestically, right? In the US, in Canada, what that looks like is going to Latin America, providing opportunities to very talented professionals in Latin America who would benefit from an increased pay coming from a company, that's based in the US or Canada. But then the company also benefits because same quality talent. However, your burn is lower because across wherever you want to staff that person, right, they're probably going to be 50% or more less expensive if you were to try to do the same thing domestically. So I think it becomes more about how can we leverage a global talent pool to build. This could be simple back office, right? Your bookkeeper, someone who's handling ops, someone who's handling what else? I don't
Marketing,
know.
yeah, any of
Yeah,
those
any
things. Yeah,
any
yeah,
any of those, but it can also go to product, right? The
yeah.
people who are building product on the tech side. Um, you can also leverage, and especially in product where you're starting to see, especially if you're talking about someone who's skilled in AI, salaries are starting to balloon to like literally $100 million. Where look, I can go get someone. In the case of someone who's making $100 million by working at Facebook, that's probably like the most talented person in the world, right? But if we're talking about, I need a machine learning engineer with 4 years of experience, that person is going to make, high six figures. How much is that going to cost me if I were to go to find someone equally talented, bilingual in Latin America? It's going to be significantly less expensive. You can produce the same product. Then it just becomes, how do you learn? Now you need to learn how to manage your team.
Yeah, yeah, no, that's powerful. We've got a couple more questions that I see jumping in the chat here. If you have a question for Darius and you want to ask him yourself, just raise your hand. We got a few more minutes left in the power hour, and that we can take. But Darius, we've got Bethany was asking about recommendations on just sort of who to work with to broker deals and valuation and raise, and if this is something that you actually do.
Yeah. So who I should work with on the broker side? I would say absolutely use a broker. There are scenarios where an investor will come in and say, "Hey, you don't need a broker." If you have enough scale, you should be using a broker. They're going to take a fee, but you don't want the investors do that. And we do it because we're like, yeah, we can get a better valuation. Come in at a lower valuation. It's less costly to us. So absolutely use a broker. On a valuation side, so yes, I do valuations, and valuation work. I do run another business, so that is not my primary core business. Separately, I didn't mention this, but it kind of plays into my um, positioning in kind of the global talent pool. I've got a company, Coganti. This company provides accounting and finance services. Valuation fits into that piece, that element of it. So that's kind of separate. But yes, you should get a broker. Um, you should get a broker that knows your industry as well, because you want someone who's going to run um, run the valuation in the way like a real estate valuation is different from a software valuation is different from a barbershop valuation, right? Services business valuation. In a lot of ways, the services and the product can look the same. You do have some folks who are generalists out there, but the reason why you want them to know your industry is because then when it comes time to actually sell or raise capital, you want them to know your end market, right? You want them to be familiar with that end market and potentially have folks that they can introduce you to. Now, that may just be your job, right? It depends on what you want. If you just need a valuation, you shouldn't expect the broker to actually, or the valuation expert to find the person who's going to get you the money or sell your company. But if it's a broker, right, that's their job. That's more of an investment banker type of thing.
Yeah.
It's important to be careful with that, though, because you need to have someone who, if they're the broker, if they're responsible for actually selling this business or raising capital for you, and they're taking a contingency fee, they need to be licensed. So there's a difference between who you can actually work with.
Yeah, no, that's powerful. And just a quick plug here, guys. You know, we are gonna be doing matchmaking with investors and folks who are like Darius, and hopefully we can get Darius into our conference in October. We have a special offer for anyone who has not yet signed up for the conference in October. The Go Global conference is happening October 1st to the 4th. Samuel is dropping a massive discount inside the chat, which is the Power Hour audience. This is for you, and it's only happening today just because you've been so loyal. 30% off the bat, no questions asked. Use that code GGCPW30, which is the Go Global Conference Power Hour. 30. I don't know how we got double in there, but double is for the work that you need to do today. But you get an opportunity to be matched with some of these investors that we're trying to bring in, like a Darius. And, you know, Darius, I'm going to make the shameless plug because we probably need to fly you in to meet some of these people in person into Atlanta. So we'll work through that. But if you want to be a part of this conversation and matchmaking that we're doing in October, please go ahead and sign up. Lock your space in so that you can have more of these in-depth conversation in October in person, and you'll be able to then secure. Hopefully, you may be able to secure some funding for your stuff as well, right? So Daryl, let's go back to some of the other questions that I've got here real quick. Robinson was asking that he's in a similar business to you. And so want to know if you can give service providers some practical advice based on your experience raising funding for a service provider.
As a services business, how do you go out and raise funding? I would say from your customers first. So as a service, so here's what my advice would be as a service provider. I'm concerned if you are a service provider and you need capital up front, because why can't you go sell your service and make, even if it's a small margin, why can't you go sell your service and then even if it's just you as a consultant, you should be able to go sell your service, make a little bit of money off of that service, reinvest that money to continue to grow, right? So that's the first step. Now, the second step I would take before I go to an investor would be to say, how do I use AI to make my services business more efficient, right? So let's say on my own as a consultant, I'm able to net 10%, right? So I sell a service, I'm making $100,000 a year, top line revenue, big distinction. I'm netting 10,000, which is a 10% margin, right? How can I use AI to get that margin to 20%? It's going to be a big difference if you approach an investor with 10% margins versus 20% margins, okay? Particularly if you're a services business. So step one is I need to be able to sell this myself. Step two, let me optimize this as much as possible with AI. Step three, now let me go and get like a small business loan or revenue-based financing or revenue-based investing. But you have to have a reason as to why you actually need that capital. So what are you going to do with the capital? And that capital needs to actually the benefits need to accumulate to the investor as well. If this is an investor that has no equity stake, that capital should actually make this business more safe. Okay. But like if it's an investor with no equity stake, it's pure debt, they're going to want to see a track record, right? So because they don't care if you become a billion-dollar company. They care more about whether this is a sustainable business, and when this debt is actually due, are you going to be able to pay this back or refinance it? If it's someone who will invest in the equity side, then the upside becomes more important, right? So I need to start selling. Why are you going to make X amount more, right, than the interest that you're going to receive? So if the interest rate on that loan is 8%, why are you going to make 15%? How am I going to get you that extra 15%? One example could be, look, we need to invest in, let's just say a particular system that's going to allow us to automate how a particular process in the business at this point in time, that process, we're having to pay an external firm $10,000. We can eliminate that if we automate it, get it down to 1,000, right? So the idea being, if I want to attract that investor, I have to do the work myself first, right? I have to sell this first, and then I have to optimize it, and then I can go to the investor who will have more confidence in what I do. I don't know a lot of investors who would invest in a service-based business if we're not able to sell the service first.
Yeah, yeah. That makes sense. Your best investor is your customer, right? So Tyrone is asking, we
Oh,
got
let me
like
throw one more thing in there.
yeah,
Don't
yeah,
quit your job. If you got a service-based business, use your W-2 as your first business. Now you're going to be working an incredible amount of hours, but like that is your best first investor.
right. Yeah, that's right on. Tyrone is asking, how can minority small business in the construction space, which we haven't mentioned the construction, but construction space position themselves to be acquired by other large minority-owned construction business? What will be the best model and strategy to be acquired? Is that a question that you can answer for him?
Yeah, so when I saw it, generally the to be acquired, it's having conversations with your particular your acquisition partners, right? Construction has a lot of different flavors. And so who are the people in your industry who could actually be acquirers for your business? Go talk to them, go to conferences, see where they're at, and start building a rapport to where you can have that conversation, right? Obviously you'll want to protect, like your customers and any IP or whatnot, but like those aren't investors. So building the relationship from a founder to founder perspective or executive perspective, I think that that's going to be important. So then when you reach a point where you've reached enough scale, it's a direct conversation with them. Now you can get a broker involved later on, but over time you're still understanding what is it that they want to see? Because essentially, if I'm trying to sell my business to a larger company, I'm just trying to sell my product, which is my business, to one. So I need to understand what they actually want. And you can
Yeah.
do that by building the relationship earlier on. Then the whole finance piece becomes important later when you need to pull your financials together and actually, have them have something that they can diligence. I would, when it comes to corporate acquisitions, I would also just, be a little careful with that, because there are a lot of times, like the thing about investors is our business is investing. So if we walk away from too many deals, people will get pissed, we'll lose our reputation. Corporations don't have that same risk. They can walk away from as many deals as they want because their customer is not companies they invest in. So a lot of times what you see is corporations say, hey, we're interested, send us all this information, do all this work, and you lose sight of running your business. And then they say, you know what, for whatever reason, we're not interested, right? So just be mindful of that as you talk to corporates in terms of acquisition.
Yeah, we dropped the poll results, guys. We're out of time, but I do want to drop one more question in there for authorities who would ask, if you need a certain, legal documents or like pending patents or trade first before seeking investment?
No, I guess if you're on the side of technology, it becomes important eventually. But most investors, I mean, because look, you can have your IP and someone could just figure out a different way to do the same thing you're doing, right?
Yeah.
However, you're going to want to get it, but to seek investment, that's not that's not necessary. Now, if the investor does say necessary, then okay, then reach out to a patent attorney. But but I haven't seen that as a necessity because there's just so many ways to duplicate what you're already building. And most investors' perspective is like really, unless you were open AI, really your like moat is around your competitive advantage is around your ability to get this product to market.
Yeah. Hey man, this was so powerful, and we got to do a part two of this at some point. I want to ask you for your final sort of advice as you've answered a number of questions and given us some tremendous advice here. And as you look at the poll result and kind of see how are people thinking about raise and what they're raising, any final bit of advice for businesses here today, Darius?
Yeah, if get involved in AI, even if it's just an hour a day, uh, spend an hour a day getting up to speed on AI. It seems like like you get these wave of like tech hype. Blockchain was one of them. Uh, there's always something, but AI is the real deal. So I would say, wherever you are, start there and buy a subscription to ChatGPT and use it for an hour a day. Let that be your starting point. Learn on YouTube for an hour a day, and I promise you the benefits are going to accumulate exponentially.
Yeah, well, ladies and gentlemen, we have come to the end of the Power Hour. The power is still within you to continue the conversation. Darius had shared his LinkedIn. And if you can connect with him there, but we'll be able to also connect with Daryl and other folks at the conference. Feel free to make sure that you are a part of that. You can't miss that because that's super important to the needs that you have for growing in 2026 and beyond. Thank you guys so much, Daryl. Big shout out to you. Thank you, my man. I appreciate you for jumping in and for serving your time here. I did saw Dr. Jackie said you are Columbus alum, right?
Colombia.
You're Lion, Colombia. Yeah. So big shout out to the Columbia Lions in the building. But thank you guys. The hour has come. The power continues. Keep going, and we'll see you again next week. We're going to be talking more capital next week to give you that full 100 on how do you raise capital for doing your business globally. Have a great day, everybody. Make sure you download the chat, and we'll definitely see you in another Power Hour soon. All right. Thank you so much, guys. We appreciate it.
Thanks, everyone.
I keep forgetting to share my screen. All right, here we go. My favorite track.
Of the Atlanta Black Chambers, the Chamber of the Year.
Atlanta is rocking. Go Global Conference is doing the things, eh?
And I think the most incredible thing to take actually home is the black excellence.
So kudos to GOC for a job well done. I think this is just the beginning of greater and better things to come.
All right, guys. Darius, we'll be in touch. I'll script you on I'll text you.
Okay. Okay. Sounds good.
Thanks, my man. Appreciate
All
it.
right. See ya.